Good morning, everyone. I am Audrey Boissonou with my co-host Kevin Casey, and today we are joined by Mr. Bill Dallas. Welcome, Bill. So good to see you.
Good to see you guys. Thanks for having me again.
I don't know what that hat and jacket are, but you sort of look like you're at a
I got a
NASCAR.
little Finance of America jacket and a Clifton Sporting Goods as a hat.
Oh, wow.
So
That's
I'm in
really
Minnesota.
fancy.
This is my Minnesota look.
Oh, gotcha. You have many looks, don't you? Every time we see you,
Yep.
you've got some other state, college, team, something's on. Okay, guys, just a heads up. So this week we've got new home sales tomorrow. GDP will be Thursday, and on Friday, our favorite, actually the Fed's favorite measure of inflation, PCE, personal consumption expenditure. It's expected to be flat or up a tenth, but we'll see. You never know, right? Never know. 2.6 is where we are currently.
So they're
Their
expecting
target is
inflation to be up a tick.
what?
They're expecting inflation to be up a tick.
Like one tick. One tick. I mean, you know
If
what?
I was a gambling man, I'd bet on one tick down. But heck,
Oh, wow. All right. Well, yeah,
we might learn why I'm not a gambling man.
Yeah, it's never good when we start making projections, as you might recall. So also just another couple of things. First of all, we have a credit certification class with Ali Zane on Thursday at 10 a.m. Pacific time. So again, if you'll recall, we had Ali on with Shiva Baskar, good Lord, like a month ago or so, and they are really credit advocates for clients. They sue credit bureaus. They go to mediation. They are not your typical, oh, we're going to dispute all your lates that you actually had and hope that, if we throw enough crap against the wall, it'll fix it. No, it's not about that. So this is really so you can help your borrowers, and especially as we're in this market where delinquencies are increasing on consumer debt that has gone, consumer debt has skyrocketed, and people are having a really tough time out there. They're taking second jobs, third jobs. And so this is a really good tool for you to have. It'll be, he says it's around an hour and a half, maybe a little less. And at the end of it, you'll have a certification that you can share with your borrowers and some more tools in your toolbox. So you can be a better mortgage professional. Okay. What do you think about that, Bill?
What time of day was that again?
That's 10 a.m. Pacific. Why didn't you have that on your calendar, for God's sake? Yeah.
I just want to make sure, because it's not 11 like our show normally.
Oh my God, don't confuse everyone. Okay, summer camp is August 4th to the 6th in Newport Beach, California. And there are some really great speakers, like the California Insurance Commissioner will be there. Won't that be interesting? So, yeah, it should be a good one. So hope to see everyone there. All right.
Spine tingling.
Bill, you could really nail them.
Oh my! Figure out why my insurance is canceled.
Yours and everyone else's. What's interesting is it's such a national problem because people are like, oh, it's only on the coast. No, if you're in a tornado zone or a hail zone or a
flood zone.
What?
Flood, like New Orleans.
Well, yeah, flood. And floods happen everywhere. And so this idea that is one region's problem is completely nonsense. And then just my final note for the day is the Chrisman Media collaboration. That's Rob Chrisman and his son, Robbie Chrisman, have put together a little group of podcasts and shows, and we are Tuesdays offering. So look at their other offerings that are various days of the week, and they cover everything. So they've got people who do compliance, and they have folks that were origination. And so anyway, look in the Chrisman commentary to see what the options are, but lots of good information out there. So anyway, let's take a dive into this. Yeah, what do you think of that, huh, Bill?
We're moving up.
That's a lot.
It's always a lot. Bill, we're in the mortgage business every week for the last 4.5 years. I have run out of time before content. I mean, it's the mortgage industry.
It's like your compliance intro to.
Oh,
it's like getting an LECD actually signed online.
Don't even
by borrower.
I've decided
or change the circumstance.
I've decided that click is useless. Nobody knows what the hell they're signing anymore at all. Like literally last night, I was telling my client, sign your CD on his $35,000 second that I am doing for him. And
Ooh.
he goes, honestly, I just sign it. I don't read it. I just know that you're going to read it and that it's going to be okay. And that's what I did on the last one. It's fine, right? And I'm like, I did review it, but you can't assume it. So people, your clients are thinking that you've got them covered. Make sure that you're looking at their disclosures, for God's sake. I mean, be a mortgage professional. Again, this is
Yeah.
why people don't call centers. It's so that they have someone actually looking out for them. So be that person, right? All right, enough preaching. Let's move it along. It's hard to know where to start because there's so much to talk about. So let's talk about servicing transfers just to begin with, because there's a lot of movement going on. Kevin's noticing it, I think, more than me, or he has whiny.
I got a client that calls me up every like 3 or 4 months. My servicing's been sold again. What's going on? Like, why do they keep doing this? Like, and I have to reset up my auto pay, and they're just, bitching and moaning about it. And so I'm like, okay, so obviously there's something going on behind the scenes. I suspect it's mortgage companies are like trying to at least not show that they're losing money, so they're selling off their valuable assets, which are servicing. And but it's interesting because I'm seeing it between companies with this one particular client. It's the same two companies that the loans go between. It's going between, I won't mention the names, but it goes from company A to company B and then back from B to A. And it's gone back and forth, 3 or 4 times now.
Why, Bill? Why would they do that? Like, don't they lose money every time they sell it? I mean, I don't know. Tell me how that works.
Well,
Tell us how that
there's
works.
like there's 3 things there that I would say that we should talk about, right? Inside of just that discussion. One, why is this being sold? I think 2, what is the preferred transaction and how does that happen? And then 3, right, it does affect us as originators, right? Because we need to retain the client relationship, and in some cases, I think that's what I think you and I sort of started talking on, was just on what are the reasons that the refi world, this next refi wave, will be different. And one of the main reasons is that servicing portfolios, not only do they defeat these trigger leads, right? I think more of the players that are buying up the servicing are competitors of yours.
Okay.
Well,
right. So whereas before, like you can, and so when you look at servicing transfer, what's the economics of it? The only servicing that can be sold is servicing that's more valuable than what you've booked. So if you book servicing at, let's say, a quarter servicing, you sell loans to Fannie Mae and Freddie Mac, and you book a quarter servicing, which is the standard that you book, that you may have booked that at 3 to 4 times that value. So the loan is worth 3/4 to a point and a quarter. If you sell it, you have to sell it for at least that, or you have to remarket and take a loss, which you don't want to do. So what's happening is most of the companies that own servicing, big mortgage companies, are selling lower coupon loans. I mean, most of the servicing that's being transferred is in under 4%.
Okay.
Right? That gives you a 4 to 5 to 6 times value, which gives them income to take into income, and that offsets their crappy losses, and then pays for and gives them cash.
Gives them cash.
Okay,
so
more importantly, gives them cash.
Make their numbers look a little decent to the stockholders, saying, "Hey, the market's crappy, but we're still making money because we're smart."
And the challenge that we have as mortgage banks is that most of these buyers, right, are the usual suspects. So I say when you're looking at people that buy servicing, you've got really 2 types. You've got the usual suspects who are competitors of yours, right? The Penny Macs, what I would say, the Bayviews, the people that, the Freedoms, the people that buy your servicing or where your loans get transferred. Those folks all have United Wholesale, Rocket, all those guys, they all have servicing defense teams. They are buying servicing because they want access to your customer the next time.
Yep.
That's the big value push.
And right? They get the trigger leads, correct?
They do. I mean, and trigger lead, the laws changed, right? So now it keeps getting more tougher and tougher for an originator to edge their way in there if you sell down that channel.
So
right? Because now you've got your competitor in your knickers and they think they own the customer. You think you own the customer, and you now are precluded from calling them or talking to them about a refinance. If they engage, you can somewhat talk to them, but most mortgage companies sign MLPAs, mortgage loan purchase agreements, and other agreements that restrict conversations in some way, shape, or form. Right?
really,
Interesting.
Yes.
It's
I did
Almost
not
everybody.
run into that.
Yeah.
Oh,
It's-
that's interesting. Well, it's interesting because first of all, it is something that all of us originators need to take note of, because in the last refi boom, the retention numbers for those servicers was not high. It was
No, it's like 20%.
17 to 22%,
Yeah.
depending on whose numbers you were looking at. But they've really amped up their efforts, and they're using AI, and they're using all sorts of different things. And there were certain lenders that we knew, like I always wait until like you're in docs before you order the
Actually-
demand, and you're praying that by then the rates are up and there's no way they can swoop in. I think Kevin and I have both on a couple of occasions for some of our favorite clients ordered a demand so that our clients could get an amazing offer from,
From
a
the
lender.
Chase, yeah, I got it from Chase.
Mhm.
Got
They're
my
famous.
client who
They
didn't
will FedEx.
qualify for a loan at 2% refi or recast from Chase. You're the best, Kevin.
Yeah, you have to choose your battles and know that, we're not going to get all of them, but for the most part, they do such a crap job in a lot of areas. But
that's why the other
amazing.
thing I would say is, if you go down path 2, right, on the other side, you have this confusing part of mortgage banking where you've got independent mortgage banks who don't service on their own. There's only a few that have their own servicing platforms, right? Guild does, but not many others, right? Everybody else uses sub-servicers. So now you've got sub-servicers. So you got the actual beneficiary, lender,
Right.
investor. You got the sub who just passes stuff. They don't call you back. You can't get a hold of them. Pisses off all your clients, right?
Right.
Then
Right.
you've got the mortgage originator, but in between that, you've got this MSR buyer who now owns the servicing on behalf of the potential investor group, and it employs the servicer. So what we're beginning to do is we're beginning to create what we call customer retained loan sales, where we're trying to engage and keep the originator in the saddle. Because we believe that the originator will get a disproportionate share of the refinance, and that should be a good thing for the MSR buyer. So I've basically spent the last 5 years trying to convince independent MSR buyers to not build their own internal systems, but to lean on the originator and then include that in the price. The other piece that we tried to do.
How does that work when you've got, like, if they're buying, whatever, if they're buying Rocket loans and are they going to keep the Rocket? Who's negotiating all this? How does this work, like, logistically? I don't quite understand.
Well, you end up so if you look at these, because like you chronicled start, right? If you look at who's buying all this MSR, and MSR, just to be clear, are mortgage servicing rights. It started as OMSR, originated mortgage servicing rights. It then moved to PMSR, purchase more, and then it just called MSR. So you've got servicing that's transferring. It transfers as an asset, but it has to be acknowledged by the investor, who generally is represented by in a Fannie Mae, Freddie Mac, or Ginnie Mae in agency. Non-agency and non-QM, it's everybody. It's banks, it's big time Wall Street firms and others. What's occurred over the last probably decade is what we call aggregators, right? And aggregators and that started really coming in out of 2006, 7, 8, and 9 in the recession, where servicers are getting crushed, right? And there's all these new services, because this cost of servicing went from about $200 a loan per year to $20,000 for a defaulted loan.
Oh,
Okay.
A year.
Okay.
Yeah, yeah,
Yep.
yeah.
And then if it's non-defaulted, it just went to thousands. So the cost of servicing ramped way up. So everybody sort of got out of it. Enter then this new wave.
Right.
And so what you're seeing in MSR buyers are just investor groups like Rice Park, Waterfall, Annalee, Two Harbors. You see people that normally create REITs or raise money from private investors and buy service. And that group is the group that we are using to employ mortgage originators, because that group really is interested in making sure that if that loan pays off, it is retained by the fund. Right.
Okay.
Interesting.
And yet inside a mortgage business, right, that's why I said, I think for each of you originators, as you think about this, you've got to really plan. I would just posit the question, why is this wave going to be different? How do you prepare for it? And why it won't save each of you?
Yeah.
Right. You're gonna think we're gonna get all this refi business if rates fall. You're not gonna get shit if you don't really understand what you're doing and how to do it. And and you can do that. You can begin to perform today, but the bigger you are, the more you should say, I got to go down this path, not that path. And then don't get tripped up by MLPAs and trigger leads and other issues inside the organization, like your traditional compensation plans. Right? Because you're going to have to price, like you guys just said, what was the most important thing? I got to have a really crisp price, or I'm in trouble, because I'll never convince my because the investor is going to get a shot at this pricing it. And that's why you want investors that will say, I just want to rely on my loan officer, because they're the ones who have the relationship anyway.
Well, I mean, what was interesting too is, like with Chase, they would do those amazing offers for a rate and term refinance, but not for cash out. So where you would have the edge up.
Actually, they wouldn't do it as a refinance; they'd do it as a recast.
Right.
Yeah,
well, and that was
the worst words for you would be a recast or a note mod.
Yep, exactly.
That's why I always said to mortgage people, the worst two words in the English language are note modification.
Yep.
Right.
That's what Chase would do. They would overnight a modification, and then you would just sign that
in the mail, saying sign here, you're done.
Hey, the good news here is the banks are getting out of mortgage.
Right.
Yes.
So they're not the buyers of all this shit like they used to be. These are all independent things. So you're not, while they have massive portfolios, right? Wells has a massive, but Wells is thinning that out.
Yes.
And so your biggest friend really is Basel III. And Basel III, there's Basel I, there's Basel II. Everybody says, what's a Basel? Well, it's a place in Switzerland, right? And Basel creates this set of guidelines that have radically changed coming out of 06, 07, 08. Basel really changed mortgage in one fundamental way. Instead of valuing a loan based upon the sale and the cash that we got from it, what do we value today? Derivative locks. And so what started was we needed the world uses different accounting than America used. So we combined that so that investors wouldn't get confused, buying our crap anymore. And so what you see now is Basel I, II, and III. Basel III basically is penalizing banks in capital. If you had a 1-to-1, if you had $1 of mortgage in a bank before, you needed 10 cents of capital when this started. 10 cents.
Yep.
Not a bad deal, right?
Yep.
Now, if I have $1, I need $2.50.
That's crazy. That's really crazy.
So I need.
No wonder banks are out.
I need so much capital. So think about a bank provides warehouse lines to mortgage banks.
Right.
Holy shit. I need
Right.
2.5 times. I need all of this capital. Do I want to buy servicing? God, no. Now I got to hold all this capital for
Yes.
that. And so what you're seeing is this, which is everybody have said, why Wells Fargo had a 42% market share. Market share of mortgages in and around 2008, 9, 10, 11, 12, 13. And they have orphaned that share categorically. Now they have other problems. They've had other problems, but at the end of the day, the biggest issues now facing banks, and they were your biggest competitor, right, over the last decade.
Yep, definitely.
Huge. And they never, in jumbo mortgages, never were priced better than conforming.
Right.
Never.
And they were.
And then what happened?
Yeah.
Right.
We got crushed over the last decade. And then, but what was the cost of funds? 0. And prime was 3.5. So we ended up paying to keep the banks in business. And one of the ways that they did that was so banks could actually make mortgages, make money, blah, blah, blah. And all of that is over.
Yeah.
Right. Which is like, ooh, now I'm getting chills. It's like a spine tingling murder mystery where there's no, DNA swab or something, right? I don't know who killed this person, or I can't find it. So I think for us, what you guys should help your listeners focus on is there's a big payoff, I think, for you all who focus and listen to me, right? Because if you can do this and position yourself well, you can take advantage of this decline in rates.
Yeah.
That's probably going to happen.
Okay,
right?
so let's go there, because
but actually,
every
it's
rate,
not going to be your 2020, 2022
no,
refinance.
every rate projection I'm seeing right now is maybe we'll get to 6% by late 2025, 26, maybe. That's Fannie Mae and MBA right now. That's that's our best case scenario. And I'm locking loans in the 6s right now. So it's not like we're going to have some massive difference. But what is interesting is that of the loans originated between 2022 and 2024, there are 2 million that are between 6 and 6.5%. There are 2 million between 6 and 5/8 and 7%, and 2 million who are above 7%. And this, by the way, just to be clear, those are loans originated in that time period. It is not every loan with those rates. That's a whole separate issue, right? So if we're looking at rates that might come down to 6%, might. Okay, so we have a few million, but again, you got to be on your A game, because the servicers are going to be very much on top of this. So get yourself prepared now, and also know this is not your business. This is not 2020, 2021, where it just rains from the sky and everyone's super excited. They are going to be.
Well, and I think, for you guys, now look, you all, most of the people on this call are good originators, right? Or they're in the TPO business, or I see Dirk and Robert. Yeah, Robert's also asked a question: Is there going to be a modification coming soon? There's all discussions, Robert.
He's saying Basel III. Is there going to be a carve out for loan? Yeah,
they're not going to carve it out, but they are in discussions constantly to try to limit this. But as long as you're in the politics that you currently are, the two people that got penalized continue to get penalized: banks and brokers. Right? It's like that has not changed from the last administration coming out of 06, 07, 08. That has been consistent. Now, you guys have done a great job in earning back the confidence of most people.
Right.
I mean, if you really think about it, they blamed mortgage originators and banks for creating an environment that gave people loans they couldn't afford.
Yeah. And
look, as brokers, as originators, my comeback has always been, we just do what they give us the opportunity to do. We can't make up guidelines. Now, absent fraud, and fraud sometimes is a component, but it's not a huge component part of mortgage. So the two things that I would say is we need to ramp up Because the other thing I would say in almost all of our customer experience, forums and dealing with customers, the first thing that they would say is, I can barely remember my loan officer's name.
Yeah.
And they have moved more than my servicing.
Yeah.
I got people that have moved 5 different companies for guarantees.
We see it regularly.
My team. I mean, so, and the loan officer relationship is really only about a 20% when a customer says why they change, right? LOs are about 20%, right? I think the rest of it comes from then price, ease of getting business, blah, 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 right? So I think my recommendation is you need to prepare to compete for every loan now.
Yeah.
And you need to get your database set up and ready and begin to ping it with, hey, let's just start. Hi, I'm Bill. Right.
Remember me?
Yeah. Thanks so much for making your payments. Right. You've done a great job. We've kept an eye on you. Right. Your home price has gone up.
Yep.
And you've done a great job in making your payments. And we are getting ready. I know you're getting ready. So we're getting ready to give you more money.
Right.
At a lower rate.
That's the key thing. Getting ready to give you more money. Because we're not getting ready to lower their rates because they already got 2 to 3% rates. But they're dying because like rates are now 7%. They need more money somehow.
They do need more
they
money.
don't want to pay 7%. And they're
spending money
on
25 and 29% items.
Yeah.
Like the credit cards.
Yeah.
Everybody's eating that. I mean, so if you look at the credit side of it, it's beginning to credit scale. And that means that there's plenty of equity. So the good news for everybody is that all we really have to do is survive today. And and for most companies, they're still losing money. They still have too big of an infrastructure. For us as mortgage originators, we are the low cost provider. We are the low cost originator. So how do we continue to win in this environment? And I think you need to build a streamlined you are going to have a partner that gives you a streamlined process so that you can get re-originated loans done faster, better, quicker than anybody else.
Right. Yeah.
That's it.
Yeah.
It won't matter what the price is.
Well, you know what, we're seeing that on purchases because I finally have some paper purchases. It's such a novel thing for me year to date, where all I've done is private money, cross collateralizations, crazy, like private money first, owner occupied. It's just nothing but that, right? And now all of a sudden, I just closed my first, I'm not joking, conventional purchase today. And the realtors, when I'm having conversations about going into contract, they're interested in time. And what I figured out is and the lenders are going, why do we have to close so fast? They don't get it. And what it is the sellers want to know they have a real deal. So it's not even that they want to close tomorrow. It's that they want no contingencies by tomorrow because they want to know that they've got a done deal. So I find that whole thing really interesting in my conversations with how do we strategize around making these offers and making them work and, offering our best foot forward to the seller without compromising the buyer, et cetera, and so it is being able to be nimble and is very, very important, making sure that can you get the appraisal done? Front loading this stuff. So I'm literally calling about appraisal turn times ahead of time, and it's really interesting out there, but not.
I think a couple things that I've seen that have changed is before you were competing against other lenders, right? Which isn't that tough a deal.
Right.
Right. It was like, oh, B of A's got this, they got that, I got this, blah, blah, blah. Right. That was easy. When you're competing against cash, that's hard.
Yep.
And you got to provide financing.
Yep.
So not only do you have to, so what's happened though, that's beginning to creep in is these contingencies.
Yep.
And before they wouldn't allow them. I just closed on one in California for one of my kids, and the number one contingency. So it was the house was listed at $890. Which in an area where it's the lowest price house in the ever, right? There's like 3 of them under 900, right? And we're trying to buy this, and so that home sells in a day and a half on a weekend, and sells for $910. So it sells for over.
Yep.
How do you and you want to get a loan?
Yep.
And the other 2 deals are cash.
Yep.
Every deal's cash. So, but what was interesting were a couple things began to creep in. One was an insurance contingency.
Yeah. Yes.
Yep.
And
Or an
people want to
HOA
make sure
contingency. HOA is another
HOA.
one.
that they and then the second was appraisal. People all sort of want to make sure that they're not totally overpaying. And the third is there's always some inspection, because am I really going to take a house without an inspection? Yeah. I mean, people did because they were stupid.
But people, find all sorts of issues. Like I had a recent.
Dude, there's so many issues in every house, especially in the lowest price. In a house that's probably worth 200 and you're paying 900 for it.
Right. Exactly.
Right? So, but my point would be to us is this next go round, you're not going to be competing against cash.
Wait, our next go round in purchases?
Purchase.
So you think cash
when all this inventory shows up and it's not selling, somebody's going to say, hey, why don't you sell your house first? I'll give you like 45 days. It'll all come back, because every one of you who lived in this with me for 40 years, we never saw a cash transaction. Never.
Well, and now they are, hang on, they're 28% of the market. And a year ago, they were 26%. So, but what's interesting with the inventory levels, and we talked about this pretty extensively, I think last week, is we are normalizing. We are not seeing a huge glut, except for the 2 states, Florida and Texas, where most of that inventory glut is concentrated. So for the rest of the Northeast is still under pre-pandemic inventory levels. In most parts of the country, with a few notable exceptions that are kind of throwing the numbers a little bit, there isn't too much inventory. There is, and also I always want to know, I'm like, okay, so you got all these houses listed on the market, because we meet with these realtors once a week. And we're hearing stories about someone who bought a house in Florida a year ago for $420, and then they listed it 3 months ago for $530. And I'm like, okay, in what scenario does that make any sense? And
their rationale is crazy.
They said, oh, we had 20% inflation, or appreciation. I'm like, not in the last 12 months. And so how much is this is speculating and buyers or sellers who are being greedy and unrealistic? And so if you bought it for $420, you're trying to sell it for $530, there's something wrong. And that's not the market so much as that's you not pricing your property correctly. And so I'm not saying that's across the board, but it is certainly worth asking the question, right? So I think it's interesting. I just want to throw this out there really quick. We are at 29% of properties are being sold over the list price. First-time home buyers account for 29% of the market right now. Cash buyers, again, are 28% of the market, and investors are 16% of the market. It's also interesting to note that we are up to the refinances being 36% of the mortgage transactions right now. So they're happening, definitely. And again, it takes strategy. It takes number crunching. You've got to really look at your borrower's total situation to see what works for them. Why should they give up that 3%? Does it make sense? And then you got to be willing to take one for the team. Like on my $35,000 second that I'm doing right now, my borrower wanted to do a full refinance, and I ran the numbers and I said, honestly, it doesn't make sense in your scenario. He didn't need that much, and it didn't make sense to disrupt his first for that amount of money. So I'm able to give him what he needs. And yes, the rate's a little bit higher, but it's not terrible. And it's
only $35,000.
lowering his monthly payments. By a huge number for him, proportionate to his financial situation. So anyway, again, you've got to make sure that you are being their advocate and that you are being more than just an order taker.
Yeah, I would say for you guys inside your organizations, do a couple things. Build a better, more streamlined process for these refinances. Second, overhaul your comp plan so you're paying people different for a return so that they can be competitive in price. Third, agencies hate cash out. Hey, I'm going to
We know they also hate investors and second homes, Bill. We know.
This last wave was perfect for us, wasn't it? Because it was just rate and term, rate and term, rate and term, rate and term, rate and term,
Right.
same borrower, and they just kept doing it. This is going to be different.
This is going to be cash.
This is cash out.
Yeah.
If there's a second, you're going to have to get rid of it.
They're going to restrict it. They're going to ask for the use of it. They're going to underwrite it totally different, like it's a new loan.
Yep.
And that's why you see this spike in non-QM. Not only are people now self-employed, they've gotten shit canned from their job. They got 3 jobs. They are self-employed and employed. I mean, come on. They aren't going to qualify.
Yeah.
Most people couldn't buy their own home back if they had to.
Yeah.
So to your non-QM point, so I have started looking at non-QM for everything. And the reason is I have these A paper borrowers right now, 800 plus credit scores, tons of money in the bank, great jobs, great everything. They are perfect borrowers, and their pricing for a non-QM investment property is significantly less than a conventional loan. Significantly. I mean, so when the GSEs impose those LLPAs, okay, that's a lot of acronyms. Sorry, guys. They really don't want those loans, I think. And they're making that very obvious.
Well,
and
remember,
so
agencies were built on owner-occupied, primary occupant purchase. So primary occupant, owner-occupied purchase.
No longer second.
One FICO, one individual, one borrower. So you start adding co-borrowers. You start doing cash out. You start doing second home. You start doing other funky properties. You start doing any of those things. It's not in the wheelhouse of America's government. So
it used to be.
Unfortunately, your last refi wave was all of that. It was right in the wheelhouse. Plus, they felt bad. They just shit on each of you and said, "Go home, don't work."
Yeah,
forbear.
Right. Yeah, they never gave us a second thought.
Oh God, now we need to send you all checks and make
you
feel better and give you loans. And that's over. This is going to be, and I think Tina had asked, what would be an appropriate comp plan? Yeah, I got 2. One for kill it, eat it, normal people, right? I love this part, right? And one for the refi. And the refi, you got to have a second. You got to have at least half the comp, because you're going to need to compete on price and speed to get this customer to come back. Now, the other piece is you just got to line up.
I just want to
line up your cash out sources. And if you don't want to end up like poor old Audrey giving people like $35,000 loans and not making any money at it, I mean, you can go to Figure, Spring EQ, blah, 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 do a second.
Yeah. Pull your hair out.
I don't know anybody, nobody I know has signed up for, hey, I really want a 10 to 12% second.
Okay, I'm just going to tell you that I just want to make sure the IMB owners and everyone understands that just because it's a refinance and a repeat borrower does not mean it isn't taking all of your days. I was for a while getting 2 to 3 calls a day from that borrower. And I love him. Thank God for him, because if I didn't, I wouldn't. Yeah, it is a lot. So it is not like those loans don't require the same amount of time and attention.
No,
it is.
They require more.
They do sometimes. So,
and because the other thing that we're seeing is almost across the board is that they've had a change in circumstance.
Right.
They've either got divorced, moved 10 times, quit a job,
someone died.
This quiet quitting, all this moving.
Yeah.
I work remote. I don't want to work. I do. All of that is thrown a wrench into, it's complicated the borrower to such an extent that they've elevated themselves to non-QM.
Yeah.
Right. And what's happened to non-QM investors? It has commoditized a bit.
Yes.
And now there's a little bit of competition, and that's driving that price down.
Yep.
Well, we have,
So you see jumbo rates have gone up, conforming rates have gone up. These rates have basically come down, and they're not pari passu, but they're close. They're close enough that all the goodies that this gives me probably, I would bet that it's probably in especially in the West, but in high density areas where there's lots of moving parts like California, maybe even New York, I bet it's 40% of the market.
So we have a question here, or we have a comment from someone saying non-QM investment loans come with payment penalties.
Only
That's where the
DSCR
agency beats them. And you know what I do? I buy it down to a year. Buy it down.
Yeah.
You can
1
buy
year.
that prepayment down.
Non-QM loans, wait. Only DSCR loans have prepayment penalties.
Well, no, because I think bank statement loans can have them too. Like, but
I mean,
again,
there's many
usually
investors
not
that
buying
don't.
investment property with it has to be investment property to have the prepay. And I agree with Audrey. I just go with the 1 year because I don't want them paying it off in 6 months anyway.
right.
And so what's another 6 months?
Yep. And
Not
when,
gonna
I
be.
talk them, by the way, guys, critically important that you're having really in-depth conversations with your borrowers up front about the hair on those loans, like the prepayment penalty. So I literally get on the phone with my borrower and I say, hey, here's the deal. And this is the difference. And this is the trade-off. And what do you think? I mean, for God's sake, your rate's a half a point better in a lot of cases. They're like, it's a no-brainer for a lot of them. So, and again, for most people, we don't think that the rates are going to come down enough in the next, 12 months to make a humongous difference. And so anyway, it is just have the conversations, do the math, and talk to your borrowers about it. It's really, really important. And so, okay, let's move it along, shall we? So we have, I wanted to talk because it came up last week and we didn't have time to really get into it. So the CFPB has proposed some new rules for servicing, and there's some concern about it. So I just want to burn through what I read in their, what do you call their things? Their, oh God, there's a name for them. Anyway, they send out a circular to say, okay, here's what we're proposing. This is what it said. So their idea around these servicing changes, which haven't changed since 2014, and between 2006 and 2014, 7.5 million people lost their homes, right? So their idea at this point is don't let a temporary hardship become a permanent loss. All right, most of us can wrap our brain around that idea. So here's what they're saying. Servicers are supposed to focus on helping borrowers not foreclosing. They're trying to make it simpler for servicers to offer help. There will be less paperwork involved. They're giving them options like temporarily pausing payments, extending the loan terms to lower their monthly payments. The current rules have rigid timing for servicers and a lot of other requirements. So they have to do certain things before the next part happens. And so it requires the borrower to submit a bunch of paperwork, et cetera, et cetera. Meanwhile, the process continues forward. And, it's like a boulder rolling down the cliff towards you. So the CFPB asked for public input in 2022, and the response was that we needed a simple, flexible approach, right? And they took the COVID forbearance measures as sort of a template for, did this work? Yes, it did.
Well, worked a whole lot better than it did in
implement more of
2008.
this, right?
Yeah.
So they figured they understand that the pandemic measures were effective and they did work. So their new proposal is thus: stop dual tracking and limit fees, reduce delays by streamlining paperwork requirements, no more complete applications before they will start working on your on your problem, improve the borrower servicer communications. The borrowers could receive notices in English and Spanish. I never understand that, because what about everyone else? But if you're going to do anyway, whatever. Doesn't apply to small servicers, and the borrowers must be communicating. So it's not like you as a borrower can just say, not do anything on that end, and you're never going to be foreclosed on. There's a time period. So you have 120 days. And if you haven't pulled it together by then, and at least been talking to them and working on this, then they can full board on foreclosure if that's what needs to happen. So for us as LOs, what we can do is communicate to borrowers as people lose jobs because unemployment numbers are getting worse, et cetera. Their credit, their debts are going up. So our job is to communicate all this to the borrowers. So Bill, for a guy who's owned companies and understands servicing, tell us your thoughts on whether you think this is good, bad, or you're indifferent.
Yeah, I mean, so look, the cost of servicing has exponentially gone up, right? So the cost of default servicing is in the stratosphere. And that's because you have to do all these different things. You have to record the call. You have to do all that. So what the CFPB doesn't talk about is they've already laden the process with so much stuff that a servicer has to do that they can't do any of the things you just said.
Okay, so I think
which is
that's
like
the whole
streamlined.
point. They're trying to roll back some of the requirements.
Well, forbearance was even, look, you guys, come on. Forbearance was even more confusing than, because everybody in California thought they said forgiveness.
Well, that got corrected pretty darn quick, let me tell you.
People only with loan officers' help, because the service, you couldn't get in contact with your sub. You couldn't even find out who to call. I mean, the clients didn't have any idea what to do. Now, eventually, this got solved because people said, it took the government probably 3 months to figure out what we're going to do at Fannie, Freddie, and Ginnie with respect to borrowers who we agree to forbearance. Even today, many of those borrowers are paying the price for missing a payment, not making 2 payments.
How are they paying the price?
Because you'll get a bad, through somebody, you'll get a bad mortgage rating.
See that, I mean, if it happened during the meltdown, not the meltdown, sorry, wrong disaster, during lockdown, then that should not be on your credit report. And then we have these resources that we will put you in touch with that will go to bat for you on that, because that shouldn't be happening.
Shouldn't be. That's right. And,
well, there's exceptions to every rule, right?
Yeah, well, I mean, it's a process that, as a result of raising the cost of servicing, people can't invest in the actual communication that you need to stay with the client. And because mortgage people have been unbundled from the servicing, those two things aren't joined. Wouldn't it be perfect if you just actually did what we used to do? You actually originated the loan, and you sold the loan to the agency, and you kept the servicing, and you stayed in connection. They always knew that First Franklin was going to be their company. Why? Because we retained all the servicing on all those loans. And I think that's what somehow we've got to bring together. Either one of two things have to happen. You have to rejoin servicing with origination, or, which I think is probably more practical, we have to begin to build this interface, this technological interface that exists between our origination, the sub-servicer who doesn't care, they're just a payment processing plant, and the MSR buyer who doesn't care. Right. No, and the agencies who care a lot. Yeah. They'll take you to task and spank you if something goes wrong. Yes, and that repurchase. So I think our focus, there's companies that have built, in fact, I really like what Guild has done, and to extent United Wholesale. I mean, if you look at the top companies in our space, United Wholesale, probably Rocket, and Guild. I'll just take those three. I'm not going to take Finance of America. I'm not going to take, Loan Depot or the other public New Res or the other public companies. I don't want to say anything bad. I'm just going to say what Guild has done, what Rocket has done, what UWM has done is they put 2,000 people in front of the servicer. Yeah. And those 2,000 people are designed to do what? Get a disproportionate share of the refinance, sell them other products if practical, and solve all their problems. Yep. Like you just said, if anything comes up, like you can't What about my taxes? My insurance was canceled. All those things that are beginning to come up, we are one step removed as originators from what we used to be.
Yes.
And we have to get our butts back
I
into
agree.
the back end of that business in
Yeah.
order for us to actually.
So Audrey was saying that how, we need to
win.
be involved when, our clients get into trouble and they can't make payments, but we never get a notice that they can't make their payments until they're in foreclosure. And then we get a notice. It'd be ideal if we got a notice when they're 15 days, didn't make.
Oh my gosh. I mean, dudes, even Bill Lowen, like Bill said, we've not raised our fee. We still get our crappy little quarter or 3/8 or whatever we get, and our cost has gone exponential. So yeah, and then to be competitive on the front end, prices, basically, let's give the consumer the absolute best price we can. Now they can basically look at, in seconds, they can compare pricing. We can compare pricing. And I think what has to happen is it's got to come back together.
Yeah. Interesting.
I like
that idea.
Audrey, in order to do what you just said has to happen, it has to be an ecosystem where, and I actually think compensation rules are all wrong, right? Because your compensation, a loan officer should be compensated for finding a borrower, originating the loan, closing the loan, right? And staying in contact with the customer. Those, and then if there's any issues that come in servicing or anything else, so if you look at those 4 or 5 things, what are you finding, right? You're finding that we're paid to do what? Close a loan.
Yep.
That's it.
Yep.
So we don't give a shit about anything else, really.
Well, and as an originator, Bill, the time I spend on all the other stuff is unbelievable. The time,
but if you could if I could pay you,
you can
in
afford
an annuity for a portion of it, I could pay you so much up front. I could pay you differently than other originators because you're better.
Yeah.
I have to pay everybody on the same comp plan for the same product.
I've
this
worked
stuff
for lenders
doesn't make any sense.
Who have had, their servicing set up where, you get a certain whatever quarterly or whatever, and those plans always go away. They always sell the servicing for some reason. It doesn't seem like it's been sustainable. But anyway, okay, I just want to quickly, because I thought it was really interesting. Yesterday, I watched Brian Buffini give his mid-year update, and I'm not really, like, Kevin knows him really well. I don't. And he had a NAR person on there as well. And I just want to quickly run through my notes from there because it was interesting. So basically, the average sales agent volume has gone from $3.4 million a year to $2.5 million a year. That is a decrease of 27%. 73% of realtors are certain that they'll be in the business in 2 years. 27% of realtors they aren't sure. That's not professional. It's not committed. It's basically, well, maybe not. No, this is not how you do a professional business, people. Okay. Also interesting. And I don't know if I'm going to say it right, but maybe it's probably Irish. So maybe Kevin knows. Coulee curve. Do you know how do I say that, Bill? No. Anyway, so basically they've tracked it over 47 years of data, right? So they have noticed that 40% of listings are usually taken mid-January through mid-March. 20% of listings are taken June and July. 25% of listings are mid-October to mid-December. This year is the opposite. So 25% of listings were taken mid-January to mid-March. That's versus 40. Then June, July have been similar. And then there's going to be a flip in the fall. So the big push, guys, is going to be in the fall this year, if he is to be believed. And I think he's fairly credible. The average NAR sales agent made $45,000 a year last year. Wow. The average, and I'm not pushing Buffini because, again, I don't have any affiliation with him whatsoever. But I think this speaks to being a professional and being coached and having, and upping your game, etc. The average Buffini real estate agent made $460,000 last year. So what that tells you is not that you should sign up for Buffini. It says maybe you should, but that you need to be upping your game and being a professional. I cannot say it enough. Professionals are winning. So there were 6.1 million sales in 2021, 3.9 million in 2023. His projections are we should have 4.6 in 2024 and 5.3 in 2025. Even if a third of those are cash, kids, that's a lot of transactions. Go get some. There's only a few hundred, no matter what number you're looking at.
I like it.
There's only a few 100,000 loan originators or way less, depending on whose numbers you're following. There's so much business for all of us, right? So there's a housing shortage. Rents are up 30%. And, and so we have all these renters and their rents have gone through the roof. They have no deductions, no way to gain wealth, no nothing. Get out there and freaking do something, for God's sake. And then Katie Johnson, who's the chief legal officer for NAR and also has another title, chief member experience officer. So she comes on, and then they had a really interesting conversation because a lot of realtors are freaked out right now. And when I listen to these two, I'm like, why? It doesn't seem like there are gigantic shifts coming necessarily, other than you got to be a professional and you've got to have a value proposition. You better be explaining why in the hell they should pay you anything. And you do it up front, and you have a buyer broker agreement, right? So it was.
I think it's going to be just like with LO Comp.
Exactly. Remember when we were all freaking out when LO Comp rolled out and we thought that the sky was falling and no one was going to be in business and it was all going to HE double toothpicks, and none of that happened. It was never an issue. So again, you have to be a professional and you have to be really an asset to your borrower, and don't buy into all the hype. It's just a bunch of nonsense. There's so much demand. We have 1.4 new good God, homes a year. And we have 2 million household formations.
I think there's one difference, right? If realtors had to employ like Redfin, and I mean, the ones who are making $45,000 a year probably work at Redfin or a place that actually just pays them for 45 grand.
Or they just do their, their nephew's loan occasionally.
Look, one of the things, and it will remain nameless, right? So I was invited in to look at a company, a big company, had 2,000 originators. 2,000 mortgage originators. What do you think the average originator in that 2,000 group, what is the average per month originate?
What year was it, Bill?
Right now.
Oh, I don't know.
0.7.
0.7?
Loans per month.
Oh, yep.
Wow.
Okay, so is anybody making any money? No. So what happens is we have way too many loan officers, because I guarantee if when I dug deeper into that data, there's about 50 people making a shitload of loans. And then there's the rest of the 1,500-ish who are doing nothing. Or trying to do something. So we are still way over capacity. And if the realtors were ever forced into the same laws that we were, which was to pay minimum wage, and we had to do meal break, time card, overtime, all the other stuff that we have to do for loan officers who don't give a shit about any of that, there would be like 5 realtors in California.
Right. Well, and I think
not 19% of every adult in California has a real estate license. I mean, come on.
That's so dumb.
So I think what you're finding is they are just now getting a little bite of the catnip that happens when the government comes in and says, we are going to help you regulate yourself.
Yeah.
Right.
Yep.
And that is recipe for disaster. And realtor, and forget the buy side, which is already getting clobbered.
Right. Big time.
They don't know what to do.
Right.
I mean, the realtors haven't said anything. Nobody knows. Blah, blah, blah. It doesn't really matter. It's if it moves to where, like, just think for anybody in California, when Uber, Lyft, all these guys were fighting over independent contractor status versus employee status. That was a big deal. Wouldn't us mortgage people like to have been in there?
Yes.
Yeah.
Well,
but no, you're in the penalty box, and you're still in the penalty box.
But now we have Waymo, and they have driverless cars, so we don't even need to worry.
Oh my God! Come on, we're both in San Francisco. That is not always great. But I just want to say that there are so many loan officers out there who are waiting for the rates to come down. If I hear anyone say that, I just want to slap the crap out of them because it's so dumb. And so I had a terrible year last year. And then what happened? I've actually started taking my own, as it turns out, excellent advice that we've been talking about forever on the show. And I just diversified and stopped giving the slightest crap about rates. So the rates are the rates are the rates. And I just started doing wackadoodle stuff. So, and not bad things. They're great for my borrowers. It makes sense for my borrowers, but I cannot control what the rates are. They are the rates. You still need a place to live. You still want to make investments. You still want to do business. So with that, you have to just get out of the, oh, it's rate.
What you need to prepare for a future that is highly competitive. But look, I got a feeling your volume overall, I mean, most the MBA, everybody, you're going to get a pickup in volume over the next 2 years of probably 40%.
Yeah.
Right. And that's a very good amount.
Yes.
Right.
Yes.
And so how are you going to get and I think, like you said, it's probably going to be cash out.
Get your disproportionate portion of that.
Cash out, and you're going to have purchases. And the bulk of purchases have almost always been from first-time home buyers. That's gotten crushed, right?
They're still a third of the market, Bill. They're not crushed.
It always has been, right? It always has been. Move up buyers have to move up.
Yep.
The boomers have to figure out what they're going to do with all their money. And then you've got to give it. They're going to probably give it to their kids.
And then they're going to buy a house.
So we have to create products and services that fit this ecosystem. Yep. And that's why I say some of it might be equity sharing. Some of it is, how do I get cash out? Some of it is just different in general. But I think you're going to need solutions.
Yeah.
We're going to need for each of you who are great originators. We have to provide solutions that fit the customers that we see.
Yep.
And instead, we're trying to jam these customers into old rules and different things. Yep. All of that changes a bit when you move into non-QM or non-agency because you're not dealing with the federal government. Right. You don't have to. Yep. We like the federal government when rates are low and we want 30-year fixed rate loans. There's a lot of good things that happen there. It's not cash out. Yeah. This is a business built for purchase, first-time home buyer purchase. And so you're going to have cash out. You've got a lot of investor. You're going to have change. I mean, like I've said to you all before, the single family residence that you all finance is basically mixed use already. So it's used for your office, it's used for rent, and it's used for your home. Yeah. So I don't know what we're going to do, but people seem to be asleep at the switch when it comes to these are the realities.
Yep.
Multiple occupant co-borrowers, investors, flipping, different sources of income. Yep. I mean, what are we doing?
Yeah, we've been doing that for years.
Just doing the same old stuff and expecting a different result.
Exactly.
And that is insanity.
I couldn't agree more. So we're going to end with Ed, who said, build the right relationship. They'll be your refi client and you stay in touch and always do the right thing. And God
bless him.
We're busy. I mean, it's busy right now. It just, you cannot be living in when the rates come down box. So Bill, we have burned through more time than
can you believe it
from you. Thank you so much for everything. And I
welcome.
I have more on my list. So we didn't even get to all of it. Gosh darn it. So we'll have you back again soon. Love you.
God bless everybody.
Thank you so much. Have a great week. Bye guys.
Stay safe. See y'all.
Bye.